Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Jack in the Box.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Because today, well, we aren't just looking at a fast food chain. We're looking at a distressed asset that is trying to claw its way back from a 47% drop.
Over the last 12 months, yeah.
This is a story about debt, angry activists, and, whether a company can shrink its way back to prosperity.
Yeah, looking at this chart, distressed feels like a polite way to put it. I mean, Jack in the Box has been absolutely hammered. It feels like every time I looked at the ticker in 2025, it was hitting a new low. But then you fast forward to the start of 2026, and suddenly we're up nearly 7% year to date.
Right.
It feels like the market is trying to figure out if the patient is, dead or just sleeping.
That is the perfect analogy.
Yep.
Technically, we call this a basing pattern. The sellers have largely exhausted themselves.
So everyone who wanted to panic is gone?
They've already left the building, exactly. Now, the market is sort of sniffing around, waiting for proof of life. And that proof relies entirely on turnaround. Plan management has branded Jack on track.
Jack on track. I love a rhyming corporate strategy. Usually means the consultants got paid well. But before we get into the shiny marketing slides, I want to talk about the ugly stuff.
Okay.
Because you can't have a 47% drop without some serious skeletons in the closet. What is dragging this thing down?
It's a combination of structural debt and a very specific geographical headache. Let's start with the debt, because that is the elephant in the room.
I saw the numbers and they made me sweat a little.
Yeah.
$1.7 billion in long-term debt against a market cap that's just been slashed.
Exactly. To be specific, their net debt to adjusted EBITDA is roughly 6 times.
Okay, let's pause there. 6 times the leverage. We hear these terms a lot, but for someone listening who isn't a credit analyst, why is 6x the danger zone?
Right.
Why isn't it just business as usual?
Well, think of it like a mortgage on your house. If you make, say, $100,000 a year and you owe $300,000, that's 3x leverage. Banks are comfortable with that.
Okay, that's manageable.
But if you owe $600,000, that's 6x suddenly. Your monthly payments are eating up almost all your disposable income. You have zero wiggle room. If your car breaks down or you lose your job,
You default.
you default. So Jack in the Box is kind of living paycheck to paycheck on a corporate scale.
Wow, okay.
And it gets more complicated because their debt is securitized. It's backed by their franchise royalties.
So what does that mean in practice?
It means if they breach their covenants, the rules the lenders set, the lenders can theoretically step in and claim that cash flow. It's a sword hanging over their heads.
That explains the stock drop. The market is pricing in the risk that they might just trip over their own shoelaces. But you also mentioned a geographical headache.
I did.
Are we talking about California?
We are. This is a crucial piece of context that a lot of people miss. Jack in the Box is heavily concentrated in California. And recently, we had the California Fast Food Recovery Act, AB 1228, which bumped the minimum wage for fast food workers to $20 an hour.
Right, I remember that. But doesn't that hit McDonald's and Wendy's too?
It does, but not equally. See, McDonald's is a global fortress. They can absorb a hit in California with profits from Ohio or France.
They're diversified.
Right. Jack in the Box has a disproportionately large footprint in California compared to its national presence. So when labor costs spike in CA, it hits Jack's bottom line much harder than its competitors. It compressed their margins right when they could least afford it.
Okay, so we have high debt, 6x leverage, and a massive labor cost hike in their biggest market. That sounds like a recipe for disaster.
It is.
So why are we even talking about this stock? Why isn't this just a sell and run?
Because of the Jack on track strategy. The market is starting to believe that management finally gets the gravity of this situation. They aren't trying to grow their way out of this with fantasy numbers. They are doing something much harder.
What's that?
They are shrinking to survive.
Addition by subtraction.
Precisely. The core of the plan is an aggressive pruning of the portfolio. In fiscal year 2025, they permanently closed 86 underperforming restaurants. The projection is for 150 to 200 total closures.
See, this is the part I always struggle with. In retail, closing stores usually signals failure, right? You want to see grand opening signs, not boarded up windows.
It seems counterintuitive, I know.
So how does closing 200 stores actually help the stock price?
You have to look at the unit economics. Remember, Jack in the Box is primarily a franchise model. The corporate entity makes money from royalties. a percentage of sales from the franchisees.
Right, they just collect the rent, basically.
Correct. But if a franchisee is running 10 stores and 3 of them are bleeding money, those 3 zombie stores are draining the capital from the 7 good ones.
Oh, I see.
The franchisee can't afford to remodel the good stores, they can't afford to pay competitive wages, and eventually they might just stop paying royalties altogether.
So the bad stores are like gangrenous limbs. They're killing the host.
Exactly. That's a great way to put it. By forcing the closure of these 150 to 200 losers, corporate is cauterizing the wound. Yes, total revenue drops slightly in the short term, but the remaining fleet is healthier.
The average gets better.
The franchisees become more profitable, which means the royalty checks become more reliable. It's painful medicine, but it stops the infection.
And part of that medicine was also the sale of Del Taco, right? Which honestly always felt like a weird marriage to me.
It was a distraction. They sold Del Taco to focus on the core brand and, more importantly, to use the proceeds to pay down that scary debt we talked about.
Are they actually doing it?
They recently made a $105 million repayment on their notes. It's a drop in the bucket compared to the $1.7 billion total, but it signals to the market, we are serious about fixing the balance sheet.
Okay, so they're cutting the fat, paying down the credit card. But let's look at the actual scorecard because the headlines were messy. Fiscal year 2025 showed a net loss of $80.7 million. Right. A negative 5.5% profit margin. I mean, if I told my bank I had a negative 5% margin, they wouldn't give me a loan for a toaster.
It looks ugly, doesn't it? But you have to separate accounting losses from cash flow. That $80 million loss includes a lot of non-cash charges, impairment costs from closing those stores, write-downs on the Del Taco sale. It's the cost of cleaning up the house.
So on paper, they lost money.
Yeah.
But what about actual cash coming in the door?
That's the silver lining. Despite the net loss, the company generated $1.5 billion in revenue, which is basically flat year over year, and more importantly, free cash flow was positive at $74.1 million.
Okay, that is a massive distinction. So they are writing off bad assets, which makes net income look terrible.
Right.
But the actual burger-selling business is still putting cash in the bank.
Exactly. And that $74 million in free cash flow is the lifeline. It allows them to keep paying their dividend, which is about 88 cents per share, and keep chipping away at the debt. As long as that number stays positive, they can survive the surgery.
But surely they can't just cut their way to growth forever. At some point, you have to sell more Munchie Meals, and this is where I get skeptical. I see they're doing a 75th anniversary push, and there's this hot mess burger campaign. Is a burger with a funny name really going to move the needle against McDonald's scale or, Wendy's marketing budget?
You're right to be skeptical. In a straight-up price war, Jack in the Box loses.
Why?
Period.
Yeah.
They cannot undercut McDonald's on price because they don't have the supply chain scale.
So what's the plan?
So they have to play a different game. They call it the barbell strategy.
The barbell strategy, like at the gym?
Similar concept balance on two ends. On one side of the barbell, you have the value menu, the 2 tacos for a low price. This is just to get bodies in the door.
The loss leaders.
Exactly. Because consumers are broke right now. Inflation has crushed the lower income demographic. But on the other end of the barbell, and this is where Jack shines, is the premium late-night innovation. The hot mess burger. The loaded curly fries.
The stuff you buy at 2 a.m.
The stuff you buy at 2 a.m. when you aren't price sensitive.
The I've made bad decisions tonight and I want calories crowd.
Precisely. That crowd is loyal, and they pay higher margins. Jack in the Box has a cult following in that niche. The strategy is to lure people in with value, but upsell them to the high-margin mess. It's their only defense against the giants.
Okay, so we have the strategy. Close the bad stores, pay the debt, and upsell the late-night crowd. But execution is everything. And this is where the timeline gets really interesting.
It does.
We aren't just looking at this stock in a vacuum. We have some serious dates coming up.
The next 2 weeks are absolutely critical. If you are holding this stock or even thinking about buying it, you need to mark your calendar.
First up is February 18th, earnings. What are we looking for? And don't just tell me EPS beat. What's the specific metric that matters here?
You want to look at same-store sales? Analysts are expecting revenue to be around $354 million, a slight 1.4% rise. But the real story, the real test, will be in the same-store sales figures. Are the remaining stores actually growing, or are they flatlining?
So if they show flat revenue despite closing 86 stores, that's actually a win.
That's a huge win.
It means the remaining stores are picking up all the slack.
Exactly. That would be the stabilization signal the market is desperate for. If they miss earnings or if same-store sales are negative, that 6x leverage ratio we talked about becomes a noose
And the stock could retest its lows.
very quickly. But earnings isn't even the spiciest event on the calendar.
Right. I'm looking at February 27th, the annual shareholder meeting. And usually these are snooze fests, but
Yeah.
we have some uninvited guests crashing the party.
We do. We have a proxy battle. And this isn't just a polite disagreement. This is a brawl. We have activist investors, specifically Biglari Capital, and pressure from Greenwood investors.
Biglari. That's Sardar Biglari, right? The guy who shook up Steak and Shake.
The very same. And he is not known for his diplomatic approach. He has been scathing about Jack in the Box's management. He looks at that negative 76% shareholder return over the longer term and essentially says, you have destroyed value and you need to go.
And he's putting his money where his mouth is.
He is. Biglari and advisory firms like Egan-Jones are withholding recommendations for the current directors. They are telling shareholders to vote against the board.
Now, for a regular investor, this sounds scary. Oh no, mom and dad are fighting. But you think this might actually be a good thing.
It's a put option on the turnaround. Think about it. Option A is that current management gets terrified of losing their jobs, so they execute the Jack on Track plan flawlessly to prove Biglari wrong. Stock goes up.
Okay. And option B.
Option B is that Biglari wins, forces a board refresh, and brings in new blood to cut costs even more aggressively.
So either the current team fixes it to save their skins, or the activists come in and fix it for them.
Exactly. Activists force accountability. In a company with high debt and a history of poor performance, having a wolf at the door ensures that management doesn't sleep on the job. It accelerates the timeline.
It forces them to stop making PowerPoints and start making money.
Correct.
Okay, let's bring this all together. We have a stock that's been beaten down, a risky but logical turnaround plan, and a proxy fight that could force a catalyst. So, the verdict. What is your bullish score on Jack in the Box?
This is a tough one because the risk is very real, but the valuation is also incredibly depressed. Taking into account the debt risk versus the potential for margin expansion, I'm giving this a bullish score of 6 out of 10.
6 out of 10. That's cautiously optimistic.
It is. It's not a mortgage the house and buy score. It's a very specialized play.
How should we think about structuring the trade then?
For the short term, I view this as a swing trade setup, maybe 1 to 3 months. You are playing the catalyst of the earnings report and the proxy vote.
Right.
The stock is basing, and any positive news, even just less bad news, could send it popping back up toward those $17 or $19 resistance levels.
And for the long term, is it a hold?
It is a multi-year hold, but, and I cannot stress this enough, it is strictly contingent on execution. You are buying the turnaround story. If they report 2 quarters in a row where they miss debt repayment targets or a same-store sales drop, you have to cut bait.
So you're buying the ticket, but you're keeping your hand on the parachute ripcord.
Ideally, yes. The thesis is that at these prices, the market has basically priced in bankruptcy. If they simply don't go bankrupt and manage to stabilize, the stock could double. It's an asymmetric bet, but a risky one.
The not dying trades. Sometimes those are the most profitable ones.
They often are.
All right. So for everyone listening, here is your homework. Watch the ticker on February 18th, post-market. Look for that same store sales number.
Yep.
And then grab some popcorn for February 27th. If Biglari starts making noise at that shareholder meeting, we could see some serious volatility.
And keep an eye on those debt levels. Every dollar of debt they pay down is a dollar of equity value created for you, the shareholder.
We will be watching closely. Thanks for breaking down the mechanics of the hot mess.
Always a pleasure.
And thank you all for listening. We'll see you next time on Smart Wealth with Joshua.